Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look outside of the S&P 500 to look at other stock indexes and other sectors within the stock market. We also look at other markets like commodities and bonds because no market exists in a vacuum. And so we want to see, is something going on in a different market actually having an influence on the S&P 500 itself? This is being prepared for Monday, October 30th. The first area that we look at is called S&P 500 valuation. What is the market valued at? Is it considered to be expensive, just about right, or inexpensive? And we have some static numbers that we use called a PE ratio. And a PE ratio of 10 is considered to be inexpensive. A PE ratio of 15 is fairly valued, or the Goldilocks number. And when we get to 20 or above, the market is considered to be expensive at that point. So the first thing that we look at is we go back and we look historically at what's called the TTM, or trailing 12 months, and we compare that. The red line is a PE ratio of 20, then the blue line is 15, and the green line is 10. And you can see that we spend a long period of time being above the 20 level. So on a historical basis, the market is considered to be expensive. Down below, this is just the difference between the S&P 500 based on price and the PE ratio of 20. When we're above this zero line, that means we're expensive. When the market is running into some trouble and going down, we see this actually coming down as well. We can also look at this in the context of different historical events over time, and you can see that this can stay overvalued for a long period of time. So we don't really use this to make day in and day out decisions. This just tells us the overall state of the economy when we look at historical values. We also look at another thing called the Shiller PE ratio, which also looks at historical values, but it spreads it out and does an average over a longer period of time. Right now, we're coming in at 28.14. To give you some context, we can see that back in the 1929 crash, we were at about 30. Well, we're at 28 now. In 1987, we were at about 17 or 18 or so. Well, we're at 28 now. And then we can also see the median and the mean, or the more average price over the period of time, is between 16 and 17. So based on this, on a historical basis, the market is considered to be expensive. But the market doesn't do that. They look forward. They will look at analyst projections and forecasts. And right now, the S&P is coming in with a forward-looking PE ratio of 17. So we're under that 20 level, but we're above the 15 level. We also keep an eye on the mid caps, which are under the 15 level and above the 10 level at 12.1. And the small caps are just a little bit above 10 at 11.2. As the market's been under pressure lately, these numbers have been coming down. Then we plot all of them on the same chart. These are all S&P, or Standard & Poor's indexes, and they are all measured on the same 10, 15, 20 point scale. And they're in different colors here, and they have a tendency to go in the same general direction with each other. But then when we get to the small caps, we have two different popular indexes. One is the Russell 2000, and that's in red, and it's on one scale. And then we have the S&P 600, which is another popular small cap index, and that's on the blue scale. I tend to use the blue one because it matches up with the 10, 15, 20 level that we use for the other indexes. Then we also look at growth versus value. Growth is where you want to buy low and sell high, something like a mega cap or some kind of a company that you think the stock price is going to increase. Value is like, okay, you're not as concerned about the stock price going up, but maybe you invest in that for dividends, or maybe we're having some difficult times in the market, and these stocks tend to perform either better or at least hold up better as the rest of the market's going down. When the market's really going up, growth is outperforming value. When the market's having trouble, value outperforms growth. So the first thing we look at is a peer growth index. And even though we've been seeing some weakness as the market's been under pressure lately, we're still in an uptrend with the blue line above the red line. But if we see follow through weakness from here, we could see a death cross with this growth index. We also look at the value index, which it's been in a more of a substantial downtrend, and that's why growth has been outperforming value. But to say that and then to prove it are two different things. So we look at some growth to value ratios. We're on the top, we have growth showing that it's outperforming value. On the bottom, we see where value is underperforming growth. Now, the reason why I have a lot of different measurements of the same thing is we use different indexes. We use ETFs that are calculated differently, and we want to be able to see the same thing at the same time with these ratios. The first one is an ETF, looking at growth versus value, showing that growth is continuing to outperform value, even though the market's been having some difficulties. Here's an inverse of that same chart showing how value is underperforming growth. Then we look at a different index that's a pure growth index showing how growth continues to outperform value. This is showing how value has been underperforming growth, but as the market's been going down, value's been showing some improvement. Then we look at a different index showing how growth continues to outperform value. Then we have a different measurement here, a different growth to value ratio, and we're above the rainbow, and we have been for most of 2023, but now we've been slipping back down. We haven't fallen too far inside of the rainbow, at least yet, but this is, as the market's been under difficult times, we've been seeing this ratio actually going down. Here's an inverse of that same thing, showing how value is in a longer-term downtrend, but it has been bouncing up lately. We also keep an eye on small cap growth versus value, which has been under some pressure lately, but in a longer-term uptrend with the blue line above the red line. And we look at mid-cap growth versus value, which also has been under some recent pressure, but still is in a longer-term uptrend. Then we look at S&P growth versus value. And I look at this every day, and I cover this in the daily videos, where even though the S&P has been really going down, you can see the ratio's been hanging in there pretty good. So when we get beyond this difficult time, and if we do have some positive action going into the end of the year, this is the smart money going in and either buying or at least maintaining some of their growth positions. And that could help the market end up going higher at some point when we finally bottom out. We also keep an eye on inflation. We look at a monthly chart of the CRB index on top, which is in an overall uptrend. And then we have a ratio of inflation versus deflation on the bottom. When this is going down, that means inflation is going down, and we're actually more in a deflationary environment. We look at the CRB index all by itself, which it is in an overall uptrend. We look at the Baltic Dry Index, which is how much does it cost to ship products from one place to another, specifically in the Baltics. And this has been really going up, and it's in an uptrend as oil prices were going up, but now it's starting to fall back. However, it's still in a longer-term uptrend. Some other markets, we look at aluminum, which continues to be in a downtrend. Corn is also in a downtrend. Wheat is in a downtrend. Fertilizer, it's in a longer-term downtrend. It started to pick back up, but now it's rolling over again. Oil, this is an area that's causing some inflationary concerns because oil is now in an uptrend as it's been going up. Gas, which this is, you feel this every time you go fill up your car or truck, where we're continuing to be in an overall downtrend with gas prices. We look at diesel. This has been going up, but then we see it falling back recently. This is what trucks and trains use to ship products around the country. Heating oil, starting to get cold now. This is in an overall uptrend after it had been in the downtrend. Natural gas also starting to go back up and getting kind of close to being in an uptrend. Copper, this is a barometer of the economy. When the economy is looking stronger, copper tends to go up. It's like a leading indicator. They call it Dr. Copper. It's not infallible, but it's something that we can look at. Well, right now, copper is in a downtrend, and on the weekly chart, it's also going down as well. Then we have a copper to gold ratio. When the economy looks better, copper does good. When there's a lot of uncertainty and geopolitical unrest, gold tends to do better. And so we're seeing copper really underperforming right now when compared to gold. We take that same ratio and break it out and look at it longer term, where the black line is the copper to gold ratio, which is declining. And then we plot the 2-year yield in green and the 10-year yield in red. And we see that in times past, they tend to move in the same direction, and they usually don't get all that far apart from each other, even though we have an inverted yield curve right now. But for the last year and a half to 2 years, we've really seen a wide spread between all of these as the economy is going through a real shifting process. Gold is still in a downtrend, but when the geopolitical events started to break out in Israel, people flock to gold, and you've got a lot of people that just think gold is everything. It hasn't really broken out yet, but it is bouncing back up as there's been uncertainty and unrest in the world. And we're seeing pretty much that same thing with silver, still in a downtrend, but it has been bouncing back up. We look at closing price for gold on the top, which has been going up, and silver, which has also been going up. And then on the bottom, we look at the correlation between the two, and this tends to be pretty strong overall. This correlation just means when it's really high like this, that means gold and silver are following each other really closely. That's actually been dropping off just a little bit lately. Then we look at a gold to silver ratio on the top. So when this is going up, that means gold's outperforming, and they both can be going up or down. When this is going down, that means that silver is outperforming. And again, they both could be in longer term uptrends. And we can compare that to the dollar, and we make some general observations from this. When the dollar is going up, gold tends to outperform silver. When this is going down, silver tends to outperform gold. We also keep an eye on the correlation, which is kind of strong between the upper chart and the middle chart right now, but not as strong as it usually gets. We keep an eye on the dollar, which is in a longer term uptrend, and that's putting some pressure on stocks. The stock market likes a weaker dollar, not only for import-export reasons, but also for conversion reasons. It makes it look like they make more money, and it makes their books look a little bit better. Here's the euro, which has really been in a downtrend compared to the dollar, even though it's bouncing back up just a little bit. And here's the dollar index on the bottom. Then we look at the Japanese yen, which is in a longer-term downtrend compared to the dollar. Here's the euro again. And again, on the bottom is the US dollar index. Here's the euro to the dollar, which is in a downtrend now, and it's at 105.6. That's getting pretty close to par, where the dollar and the euro are almost at about the same level. If you're thinking of going to Europe, now might be a good time to do that. Of course, you might risk your life getting there because of the geopolitical things going on, but usually the euro has been a lot stronger over the last couple of decades. Now it's seeing some more weakness. We also look at the Japanese yen, which is in a downtrend when compared to the US dollar. Here's the British pound, which now we're seeing a crossover negative. We saw this about a week ago, where this might be a good time to go to England. It's not quite at par yet. It's 1.212, but it has been declining, where it did get up above 1.3 there for a while. Some different indexes that we look at, and I show this every day almost every day in the daily video update. This red line is the equal weight index, where it takes all the stocks in the S&P 500 and treats them the same. And this is really underperforming, showing that the broad market is weaker than the really big stocks, because the S&P itself, even though it's been going down, has been holding up better than the equal weight index. We look at a ratio between the S&P 500, which are stocks, and the CRB index, which are commodities. And this is starting to go back down now. We're seeing a crossover here where the stocks are starting to underperform the CRB index. Here's an inverse of that same chart showing how the commodity index is starting to outperform the S&P 500. And that could be somewhat inflationary, but we're not seeing that in our other charts, at least yet. Here's a ratio from the NASDAQ 100 and comparing it to the S&P 500, and this is still holding up pretty strong. The S&P 100, which are the biggest stocks in the S&P 500, they're continuing to hold up fairly well. The NASDAQ is doing better than the S&P 500, even though this ratio has been chopping sideways recently. And the NASDAQ 100, which are the biggest stocks in the NASDAQ, it's really outperforming the rest of NASDAQ stocks. Here's the mega cap growth. These are the big gargantuan companies that seem to be driving the market these days. And we compare that to the equal weight index, and it shows that the mega caps are really doing well. Even though the S&P has been going down, this ratio has been continuing to go up. We also keep an eye on small caps. That's the red line, where we have a ratio between small caps and the S&P. When this is going down, that means small caps are underperforming. That's not necessarily a good thing. We want to see this going up if the S&P is also going up, because we're seeing more broad participation in the market. Here's another ratio between small caps and the S&P, where they're in a longer-term downtrend. We look at the biggest software companies in the US, and they've just given us a recent death cross here, and this is starting to now go down. That's not positive. That's actually negative, and this is part of the tech sector. The mega caps, these are the gargantuan companies. Even though they're falling back, they're still in a longer-term uptrend. Robotics and the AI ETF, that's been all the craze in 2023. A lot of people think, got to get into these kinds of stocks. Well, when you look at this ETF, it's actually doing pretty bad right now. But it gets even worse when you compare it to the tech sector. It's really underperforming. So this has been one of those kind of hype areas that a lot of people were involved in with Chat GPT and all that stuff and BART and things. Well, the stock prices just haven't been really justifying things going higher at this point. We look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together into one average index. And this is starting to show some weakness. We're rolling over and seeing a death cross here, and this has been going down as of late. Then we look at the S&P 500 and compare it with shorter-term bonds that mature from 1 to 3 years out. This is starting to break below the rainbow, showing that stocks are underperforming. Then we look at the broad market. We go outside of the S&P 500 and look at a broad range of stocks, and these are also underperforming further out bonds currently. So it's showing that stocks are pretty weak right now. We look at the low volatility ETF, which is in a downtrend now. It held up better in 2022, but it's now starting to go a lot lower in 2023. Not a lot lower, but breaking lower currently. We look at a ratio between low volatility and the S&P 500, where it looks like maybe we've come down and we've hit this bottom again, and now this is starting to bounce back up. So this is what we've been watching lately. If low volatility stocks really start to outperform and show more improvement, that could be negative for the buy low and sell high part of the stock market. Then we look at the tech sector and compare it with further out bonds, where the tech sector is still holding up okay, but it's coming further inside of the rainbow. Then we look at the S&P 500 and some other stocks. Here's an advanced decline line study across multiple indexes, where we have the NYSE, which is just common stock, and that's probably most of the stocks that you own are called common stocks, because there's a lot of other crazy things that trade on the New York Stock Exchange. But this is showing that we're negative. We're below a declining moving average. The S&P is also declining, as are the mid caps and the small caps. And then we look at traditional Dow theory, which has been under a lot of pressure with the Dow lately. But what we're seeing more of right now is weakness in the transports. In a good, solid environment, we want to see the transports doing well, and they're not doing well right now. And the utilities, which have been weak lately, and that tends to be good for stocks. And they've been kind of bouncing around lately, but they saw some weakness in Friday's session. We look at a ratio between the transports and the S&P 500. When this is going down, that's negative. That means that transports are underperforming. We want to see this going up for things to be more positive. Then we look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming the transports, which is not positive for stocks. Then we look at a correlation between the S&P 500 on top and the transports, and they're having a really strong correlated relationship currently. And they're both going down, so that's why they're strongly correlated. Then we look at a new take on Dow theory, where instead of using the Dow on top, we switch that out and put in the S&P 500, where it's been under pressure lately. And then on the bottom, instead of using transports, we look at the NASDAQ, which is mainly tech, and that's been under a lot of pressure lately as well. We mainly look for convergences and divergences here, and right now they're both going down and showing us that they're converging with each other. If one is breaking out and the other one is not, then that's when we get a little bit nervous about things. Keeping an eye on the FANG index. This is Facebook, Amazon, Apple, Netflix, Google, and a bunch of other ones. They were up in Friday's session, but we're still below the 50-day moving average. However, we're also in a longer-term uptrend. And then we're keeping an eye on this too. We broke support on the FANG index, where you had a low level here back in August, and then another low that we hit in September. We've broken below that. Now, we're not very far away from it, but the fact that this support level has been broken is negative. ARC, which was looking a little bit better, it got all the way back up to 50. Now it's dropping into the mid-30s again, and we're starting to see a death cross on the daily chart. Then we look at the S&P 500 and compare it with stocks in Europe, Australia, Asia, and the Far East, where the S&P is still continuing to outperform. Now, this is a monthly chart, so this can take a while for this to change. We're also showing down on the bottom that the momentum for the PPO is above zero and continuing to climb. So U.S. stocks are doing better than world stocks, at least on a very long-term monthly chart. We look at bonds as well, where based on price, bonds have been under a lot of pressure lately, so this ETF is going down. We look at world bonds, which are coming down and testing this previous low here. They're also in a downtrend. excuse me, we look at a monthly chart of a stock to bond ratio showing that even though stocks have been under pressure and bonds have been under pressure, longer term stocks continue to outperform bonds. Here's a shorter term look showing how bonds are underperforming stocks even though they ticked back up recently. These are high yield corporate bonds, or you could also call them junk bonds. They're holding up okay. They're still in an uptrend, but they have been seeing some weakness, and this tends to follow along with the stock market. And these are more conservative bonds called investment grade corporate bonds, where they're in a downtrend when we look at them based on price. When you look at riskier bonds, which are like junk bonds or risky company bonds, and compare them with more conservative bonds, folks are tending to get still in the more riskier bonds. They're willing to assume more risk because you get quite a significant higher yield from those bonds, and folks are willing to do that. If this is going down, that means folks are more risk averse and they'd be getting into more conservative bonds. We look at a correlation between stocks and bonds where it's coming down into about the neutral area now, where they had been going in the same general direction for August and September. Now we're seeing that trailing off. We look at the Dow Jones Corporate Bond Index, which is now in a downtrend based on price. Here's the 10-year yield, which is not quite up to the 5% level yet. We kind of hit that area and then started to come back down, but interest rates are going up. And the 10-year is the benchmark for the U.S. economy. It's what we also use to compare with other country yields. Here's a longer-term look at the Treasury yield, where for 40 years, we've been seeing a series of lower highs and lower lows. Now we're wondering, are we shifting into a new environment, which is really the old environment, just redone again? This is the old norm here, where we typically have a higher interest rate environment. And this is going to take some time to play out. Some of this we'll only know in hindsight, but it does look like we're heading into a lot higher interest rate environment. Here's the 30-year yield, which hasn't come all the way back up to this 5.34%, percent level yet. We're just a little bit over 5% with the 30-year yield. And then we compare the S&P 500 with the rise or fall in the Treasury yield. This is just showing that the S&P is really underperforming the rise in interest rates. Look at junk bonds again here, where we're in a longer-term uptrend, but we are seeing some weakness. And then we compare junk bonds with more conservative bonds, and the junk bonds are really outperforming, even though both have been under a lot of pressure lately. Here's an ETF going from the 7 to 10-year Treasury bond. This is based on price. We're seeing a little bit of an improvement here with the RSI, but we're still below 50. We have seen a recent death cross here created back in August, and we're seeing a little bit of an improvement with the momentum when we look at the MACD. Then here's just a daily chart of the different yields across all the different maturities. We can see how they've been going up overall. And you've got the 3-month just way up here as all these different yield curves are inverted. Here's a weekly chart looking internationally, where the green line, that's the US. We have the highest interest rate here, followed by the UK in black and Germany in blue. And then even Japanese rates have been going up, and that's the area in red. The MOVE index measures the volatility of bonds, and that's been pretty much chopping sideways, whereas stocks have been under pressure. We look at the VIX. This has been going up, measuring that there's a lot of volatility in stocks. And we look at the correlation between the two, where stocks have been a bit more volatile than bonds. So this relationship is dropping off just a little bit. Here's a monthly chart of the 30-year based on price, 30-year bond based on price, where it's in a pretty significant downtrend. But when you look at the ratio between the price of bonds and the CRB index, this is continuing to be in a longer-term uptrend, but it is rolling over a bit. But keep in mind, this is a monthly chart, so it takes a long time for this to change. And we look at different sectors, and most sectors now continue to be underwater. When we compare the materials sector with the S&P, materials are underperforming, even though they bounced up over the last few days. Communication, this has been one of the stronger areas, and they continue to be in an uptrend. Energy is now starting to come into an uptrend. We've seen a recent golden cross here with this ratio. The financials, we really crashed last March when the whole banking thing started to explode. And we've been pretty much chopping sideways because as interest rates are going up and there's more inflationary concerns, everybody is saying, okay, when is there going to be more banking news that comes out? When is the next bank failure going to actually happen? And the market doesn't have a lot of confidence in that. So this sector has been really underperforming. The industrials are also in a downtrend compared to the S&P. The tech sector has been one of the stronger areas, and it's holding up better. Staples have been weak in 2023. And we look at real estate, which is in a pretty significant downtrend. Housing prices are going up, interest rates are going up, and people are having a more difficult time either buying or selling a house. Utilities are also in a downtrend, even though they've been bouncing back up recently. And here's a ratio between the S&P and utilities. When this is going up, that means the S&P is outperforming, and that's usually positive for the stocks. And it has been going up and really didn't help all that much, but now it's starting to come back down, at least in the short term. Healthcare is in a downtrend compared to the S&P. There's another look at healthcare showing how it's underperforming. Here's discretionary, which has been a stronger area in 2023, but lately it's been seeing a lot of weakness. It's still in a longer-term uptrend, but we want to see this really start to go back up if we want to see some improvement in the stock market. Staples have been under pressure and continue to be in a downtrend. The tech sector is still in an uptrend, but showing some recent weakness. Semiconductors, they were up pretty strong on Friday, but they've fallen below their 200-day moving average. However, they're still in a longer-term uptrend. The tech sector compared to the S&P shows that tech has been chopping more or less sideways, but it's still in an uptrend. The energy sector compared to the tech sector, this had shown that energy was really underperforming, and now it hasn't quite crossed yet, but it could generate a golden cross here soon if energy prices continue to go up. Then we look at growth stocks, which is buy low and sell high, and we compare them with bonds, and it shows that growth has been really outperforming, even though it's seeing some recent weakness. We look at the tech sector and compare it with the rise or fall in interest rates, and now we're seeing where tech is underperforming the rise in interest rates. A lot of tech companies have to borrow a lot of money, and if they have to pay higher interest rates for the money that they borrow, that's going to bite into their earnings. And here's an inverse of that same chart showing how the rise in interest rates are now outperforming the tech sector. Discretionary continues to be positive when compared to staples, but discretionary has been weak lately. And staples have been in a down trend compared to discretionary, but they've been bouncing back a bit lately. We look at gold, which is really spiking up because of this geopolitical unrest when you compare it to the S&P. However, it's still in a longer-term downtrend. And the dollar's been strong and gold has been bouncing up, but gold is not really outperforming the dollar right now. High leverage loans, and I say this every week, if we were getting ready to fall off a cliff economically, would this be going up the way it has been? This has been hanging in there and is in a solid uptrend. These are risky loans. And if the people that invest in this saw a lot of risk, they'd be selling this index instead of buying into it. And it still continues to be rather strong. This is suggesting that the economy is still hanging in there for right now. We look at the NYSE composite, which is a broader measure. It's starting to give us a death cross here and has been coming down lately. We look at all stocks, which is in the US as well as international stocks. They've been seeing some weakness. We're still in an uptrend, but if we see more weakness, we could see a death cross soon. Emerging markets are also starting to go into a further downtrend. The micro caps, they're setting a new 52-week low. It seems like every other day now. They've dropped below the 100 level. And then we keep an eye on the home builders, not really seeing anything crazy in this chart. On the top is the S&P, which has been in a decline. The home builders have been in a decline. The ratio has been declining overall. And the correlation is kind of strong with each other right now. We pay attention to this when we drop down to this dashed line. And at that point, we're looking for some kind of divergence that's going on. And we're just not seeing that right now. Here's Bitcoin, which is enjoying some positive seasonality. It jumped up into the 35s. It ended up closing in the 34,000 area. Another couple of days, and we might see a golden cross with this index. We look internationally where China is in a downtrend, and we're using the KST, which is a momentum oscillator, to look at this. Emerging markets are in a downtrend. Europe's in a downtrend. We're rolling over in Japan. We were trying to show some improvement in the US, but now we're starting to turn down across the board globally. Here's an intermarket analysis chart going back to the beginning of 2023, where now we have oil in the lead, followed by gold and then stocks, where stocks have been doing the best earlier in the year. And then on the bottom, we can see where bonds went negative as of August, and they're continuing to fall. Some different correlations. This is the S&P 500 to the US dollar index, where it's pretty much neutral right now. They had been going in opposite directions. That's when we get a low reading here. Well, now they're starting to come back more in line with each other. We compare the S&P to oil, which also was going in opposite directions because oil was going up in an inflationary kind of way, and that was spooking out the market. That relationship seems to be kind of waning now, and they're having a slight tendency to go in the same direction, which right now is down. And we look at the S&P to the 10-year yield, getting close to this neutral area, but they're having a slight tendency to go in opposite directions. The tech sector to the 10-year yield, kind of the same thing, near the neutral area, but still in opposite directions. We look at the S&P to the 2-year yield, and we're seeing that they're actually going in the same direction right now. The 2-year yield has been falling, and stocks have been falling, and that's why we're seeing a real spike up in this correlation. Then some long-term secular, which means decades, or cyclical, which can mean years, trend studies. We look at a monthly chart of the NYSE, where we're dropping below this red moving average. That's negative. We're still above zero, but rolling over a bit here with a thing called the Kopic curve, which is another momentum oscillator. We look at a daily chart of the NYSE, and then we look at a thing called the NYSE record high percent index, where it had been going up rather nicely. Now it's starting to go back down. That's negative. And here's the S&P with a momentum oscillator where it's starting to roll over negative. We're also starting to drop below the moving average here, and this is also a monthly chart. Then we compare the S&P 500, which is on top, with the CRB index, where the S&P is still in an overall uptrend, but we're seeing more strength in the CRB and more weakness in the S&P 500, and that's why this momentum oscillator may begin to roll over fairly soon. Then we look at the S&P 500 and compare it with global stocks, where the S&P continues to outperform. We're seeing the KST, it's still negative, but it's trying to turn up overall. Then at the very end of this video, I look at all the things that are positive and list them, and then all the things that are negative. My definition of positive is when the 50-period simple moving average is above the 200-period simple moving average. The growth indexes, even though we're getting close to a death cross, we're not there yet. The CRB index is positive. The dollar is positive. Mega caps, the Dow Jones Composite Average, that should actually be added to the negative slide. We're just seeing a death cross there now. The FANG index as well as ARC is starting to turn more negative. I thought I checked this before I did it. We look at bonds, the high yield and junk bonds, the more risky bonds, they're still hanging in there okay. The tech sector and the semiconductors, even though they're seeing some weakness, are still in longer term uptrends. High leverage loans, they're doing really quite well right now. The Dow and the mid caps are still positive, but we're starting to see a death cross in the mid caps. In another few days, if we're below the 200-day moving average, the Dow might end up turning negative. The NASDAQ and NASDAQ 100, they're hanging in there for right now, but we've seen a lot of weakness in these indexes. The NYSE composite should also be added over to the negative side. It's actually seeing a death cross here. I really thought I checked this. All stocks are showing some weakness, but still in an uptrend. Those things that are negative, that's when the 50-day simple moving average drops below the 200-day simple moving average. The value indexes are still quite weak. Gold and silver are still in downtrends, even though they've been bouncing up lately with all the geopolitical unrest. Copper is in a downtrend. The Japanese yen, the US to euro ratio, and the British pound, they're all in downtrends compared to the dollar. The dynamic software index, those are the 30 biggest software companies. They're in a downtrend. The low volatility ETF, even though it's been bouncing back up, is still in a downtrend. Staples are in a downtrend. The total bond ETF, world bonds, small caps and micro caps, they're in downtrends. Emerging markets are under a lot of pressure, and we have investment grade as well as corporate bonds based on price are in downtrends. And then Bitcoin is still in a downtrend, but it's spiked up a little bit over the last week or so. It could be generating a golden cross fairly soon. Thank you. I really hope you found this helpful. Please feel free to check out the daily videos that I post and the weekly video that I post. After this, I will be preparing what I call the deep dive video, where I go through the charts that I didn't really use in any of the daily videos just to see if we can get any insight from those charts. Have a really nice weekend, and I will talk to you in the next video.